Hello everyone, welcome back. Today we're gonna study the second part of the last chapter from Corporate Accounting and Auditing, that is Audit of Different Undertakings. So the part 1 has been already uploaded, kindly check them, and the PDFs will be given in the comment section. Let's get started. So banks are not like normal companies, they handle public money. So audit is stricter and RBI controls it. So here we will cover why bank matter, the types of banks, the laws governing banks, and how bank audit works. So the first one is importance of banking institutions in the economy. So why are banks so important that we need special audit? First one is banks are central to economic and financial system growth. If banks fail, economy crashes. They act as key agents of financial intermediation. This means channeling savings into investments. That is, your 100 rupees FD, the bank gives loan to business and that creates job. Next is strong banking systems are essentials for a stable and growing economy like India. The fourth point is under RBI's leaderships, banks operate in a competitive yet regulated environment. That is, RBI controls them tightly. Fifth one is regulatory framework aligns with international best practices. That is, RBI follows Basel norms. And the sixth point is that India has undergone significant financial deepening. That means more people are using banks, loans, and UPI. So focus on orderly financial markets and sustainable growth is done. Now let's see the different types of banks in India. So not all banks are same. So RBI classes them into 6 banks, that is commercial banks like SBI, HDFC, ICICI, regional rural banks or RRBs for agriculture or rural purposes like Kerala Gramin Bank. Then cooperative banks like State Corporation or Urban Cooperative. These are run by the members. Then development banks like NABARD or SIDBI for long-term projects. Payment banks like Paytm Payments Bank, that is, it's only for deposit as well as payment and no loans are provided. Next or the last one is small finance banks, like they are for small businesses and for unorganized sector. Now let's move on to the regulatory framework of banks in India. So banks don't follow just Companies Act. They have special laws. So major laws governing banks include Banking Regulation Act 1949. So this is a main law. RBI controls the license, audit and capital. Next is Companies Act 2013. This applies to banking companies also. Third one is State Bank of India Act 1955 and this is special for SBI. Next one is State Bank of India Subsidiary Banks Act 1959 and these are for all associate banks. The next is Regional Rural Banks Act 1976 for RRBs, Information Technology Act 2000 for digital banking and cyber audit, then Prevention of Money Laundering Act 2002 like PMLA. These banks must report suspicious transactions. Now let's move on to the next topic, that is audit of financial statements of banks. That is, now we are going to see how is the bank audit different from company audit. The first one is form and content of financial statements. So section 229 subsection 1 and subsection 2 of Banking Regulations Act 1949 governs the form and content of financial statements for nationalized banks, SBIs and RRBs. So banks must prepare balance sheet as well as profit and loss account. The balance sheet must be prepared in Form A of the third schedule of the Banking Regulation Act 1949 and profit and loss must be in Form B. So the difference is that the bank balance sheet shows cash balance with RBI first, whereas the company shows assets first. Why? Liquidity is the key for banks. The second point is statutory audit of banks. So section 30 subsection 1 of Banking Regulation Act 1949 states that a banking company must be audited by a qualified auditor. Now we will see the appointment of auditors. So the auditor of a nationalized bank appointed by CAG of India, that is Controller and Audit General, and RBI gives panel and Controller and Auditor General appoints. Next is regional rural banks. Auditors are appointed by the respective bank with approval from the central government. So why is that Controller and Auditor General for PSU banks? Because public money is involved and independence is critical. Private banks like HDFC the board appoints the auditor and the RBI approval is needed. The third point is the auditor's report content. So the auditor must comment on 4 things in main audit report. The first one is true and fair view, whether the financial statements reflect the true condition of the bank. Here are the numbers real or cooked are mentioned. The next one is transactions, whether transactions of the bank are within its powers. That is, can a bank do forex trading? Yes, if RBI allows, and the auditor checks that. The third is returns from branches. If the returns from bank branches are adequate for audit purposes, whether they are computerized or manual. So if SBI has 22,000 branches, auditor can't visit all. He relies on branch returns. Other matters. Any other issues should be reported to the central government like fraud or NPA hiding, etc. So, bank audit report is stricter than company audit. You report to the RBI, central government, and not just shareholders. Now let's see the auditing aspects of bank's financial statements. So before starting audit, auditor must do 6 steps. First one is understanding the bank and environment. That is, review the bank's environment to assess risk and determine audit plan. Second one is understanding the accounting process. Gain understanding of the bank's accounting process, whether computerized or manual. The third one is understanding the risk management. That is, analyze the bank's risk management process for both financial and operational risk. The fourth one is audit plan development. Create a detailed audit plan considering materiality and risk. So high value loans means high risk. Next one is Basel framework understanding. Understand the relevant Basel framework for the bank, and this will lead to capital adequacy norms. Next one is reliance on previous reports. Evaluate reports from previous auditors, the RBI and internal audit reports. So RBI does inspection and auditor reads it. So these are the general issue to consider. Now let's move on to the specific issues in bank audit. So the first one is advances, that is the biggest asset for bank, 60% of balance sheet. So ensure internal control is in place for advances. So loan sanction process. Scrutinize subsidiary ledger and control accounts, as well as ensure proper documentation and recovery schemes for overdue amounts, that is check NPA files. The second one is cash in hand. Ensure internal controls are in place. Inspect physical cash in bank branches, ensuring it matches the cash book balance. So there is surprise verification. Then verify foreign currency held and its translation at the current exchange rate. The third one is balance with RBI. Inspect the ledger balance, confirm with RBI using bank confirmation certificates and ensure proper reconciliation. The fourth one is balance with other banks. Inspect reconciliation statements to verify no debit or credit has been left out. The next one is, the fifth one is money at call and short notice. Check authorization system for money at call or short notice. The sixth one is fixed and other assets. So verify appropriate accounting method and ownership documents. Check schedule of fixed assets for additions and examine sale deeds for asset disposals, as well as ensure correct basis of revaluation of assets. The seventh one is borrowings. So check correct disclosure of borrowings from RBI and abroad. Verify interest rate appropriateness and ensure borrowings at call or short notice are properly authorized. The eighth one is deposits. So ensure interest accrued but not due is correctly shown. Look for signs of window dressing. For each item, auditor checks the existence, ownership, valuation, disclosure. So this is EOVD. The ninth one is capital. Capital is bank's own fund. So auditor check four things: verify opening balance of capital. So that is, it must tally with last year closing. Check resolutions or memorandum of association for changes in authorized capital. Inspect the documents for increases in subscribed or paid up capital. Then review government notifications for fresh capital infusion. So why this matters? So capital adequacy ratio is capital divided by risk assets. So if capital is wrong, capital adequacy ratio is wrong and RBI will penalize. The 10th one is reserves and surplus. So reserves means profit kept aside, and here the auditor checks the opening balances of all reserves like general reserve, statutory reserve, checks the additions or deductions, as well as for foreign branches ensure compliance with foreign laws. The 11th one is bills payable. So bills payables means the draft or mail travelers checks issued by bank but not yet paid. So the bank owes money. This is a high fraud risk. The first one is check internal controls over bills payable. So the auditor should evaluate if internal controls exist and work properly. The second one is check private code system. Banks should have a reliable private code for telegraphic messages between branches. The third one is verify demand draft signatures. Signatures on demand drafts must match the specimen signature book checked by officer. The fourth one is confirm telegraphic transfers and demand drafts. Remittances issued by one branch must be confirmed by the receiving branch. The fifth one is check cancellation of drafts. If paying branch does not get confirmation, it should investigate immediately. When a draft is cancelled, auditor should check manner of cancellation, prevention of misuse, frequent cancellation or reissues must be examined carefully. Now let's move on to the next one, that is contingent liabilities. So contingent liability means possible liability, not on balance sheet but very risky. So the first one is identification. Auditor must ensure all contingent liabilities are identified and properly disclosed. The second one is that check internal controls, ensure proper internal controls exist so that the contingent liabilities are executed only by authorized persons and are as per the laid down procedures. The third one is examine letters of credit or LCs. So for import LCs, check if overseas payments are made only after verifying the shipping documents. The fourth one is accounting system check. Ensure the bank maintains proper records for contingent liabilities. Internal controls must ensure all contingent liabilities are identified and recorded correctly. The fifth one is perform substantive audit test. So here confirm the completeness of contingent liabilities through confirmations examining the relevant records. The sixth point is review year-end estimates. The seventh point is review comfort letters. So check whether comfort letters issued by the banks are considered for contingent liability disclosure. Now let's move on to the next topic, that is bills for collection. So bills for collection means bank collects money on behalf of customer. Those are not bank's money. First one is scrutiny of intra-bank bills. The auditor must check if bills drawn on other branches of the banks are included in the bills for collection. The second one is outward bills verification. Outward bills are generally available with the bank on the closing day, and the auditor may inspect these bills at that time. The next one is that the auditor must verify the existence by cross-referring the register, and subsequent collections check post-balance sheet collections as well as crediting procedure. Customer credited only after the actual collection. The next one is treasury operations, that is forex and derivatives. So first one is risk identification, second one is impact of failure. Then auditor's role is to assess the controls, get complete overview of the treasury. The audit program means design based on risk assessment of treasury, and the ultimate goal is that assurance that treasury figures are true and fair. Now let's move on to the fifth subchapter, that is audit of cooperative societies. So cooperative societies means association of persons who voluntarily join to achieve a common economic objective through a democratically controlled business organization. So the key characteristics are mutual benefit and welfare of members. Members contribute capital equitably, that is one member is equal to one vote. So the risk and benefits are shared fairly and eliminates middlemen, and they focus on fairness, transparency and cooperation. Now let's see the types of cooperative societies. First one is consumer cooperative societies, then housing cooperative societies, industrial cooperative societies, agricultural cooperative societies, urban and rural cooperative societies, and the last one, the sixth one, credit societies. So in case of credit societies, various types are formed depending on purpose. Now let's move on to the next topic, that is statutory audit requirements. So the first one is mandatory audit. Registrar must audit or appoint an authorized person to audit every registered society at least once every year. So audit is compulsory every year, no exemption, and unlike small companies. So the next one is scope of audit. Audit must include examination of overdue debts, that is members not repaying the loan, as well as valuation of assets and liabilities of the society. Is the stock is real? Is loan real? So cooperative societies deal with member money. Overdue debts means risk to society. The third one is access to records. So registrar, collector or authorized persons must have full access to books, accounts, papers and securities. Officials and employees must furnish relevant information regarding transaction and workings of the society. So the auditor has wide powers. Society cannot say confidential. Then the fourth one is definition. So registrar is a person appointed to perform duties under the act. He is the controller of cooperative societies in state. Now let's see the qualifications of auditor. So who can audit a cooperative society? First one is generally only a chartered accountant as per the Chartered Accountants Act 1949 can audit a cooperative society. Some states have additional allowance like persons holding government diploma in cooperative accounts or persons with experience as auditors in the cooperative department, and these individuals may also be permitted to act as auditors. So many small societies in villages and CA may not be available. So government allows department auditors. The next one is appointment of auditor. So the process is different from company audit. Auditor is appointed by the registrar of cooperative societies and not by members. The auditor conducts the audit and submits a report to the registrar and each society. Audit fees are paid by the society according to the scale of fees prescribed by the registrar or provisions in the bylaws of the society. So calculation of audit fees varies depending on the books and accounts, sizing of working capital. Now let's see the books of accounting records. So what books must a cooperative society keep? Under section 43 subsection 1 of the Cooperative Societies Act, the state government may prescribe books and accounts to be kept by a cooperative society. So the registers commonly maintained are cash book, stock book, property register, etc. Let's see each of them in detail. First one is cash book. So this records cash receipts and payments and must show daily cash balances. So clear distinction between capital and revenue items will be given. Next one is stock register, maintained where stock or inventory is involved and includes item-wise quantities, quality and valuation. So the producer societies means production materials like dairy cooperative keeps milk stock, and the consumer societies means goods for sale. So cooperative store keeps rice or sugar. Then the third one is asset register. So this records society's fixed assets and includes asset depreciation, location, cost, acquisition date, etc. So this is to prevent misuse of society property. Next one is register of fixed deposit. So these are for credit societies or cooperative banks. So this records deposits accepted from members or non-members if permitted by bylaws and must contain date, amount, the maturity date, the interest rate, etc. Then the next one is register of surplus. So these are for credit societies dealing with loans. Maintains loan details, security taken, the borrower details, the outstanding amounts, etc. The next one is restriction on shareholding. So as per section 6 of the Cooperative Societies Act 1912, no member other than the state or another registered society may hold more than 20% of share capital of rupees 1000 worth of shares, whichever is less. So why this rule? To prevent one person dominating the society. The auditor should vary the compliance, that is check member register, and report if any member violates shareholding limits, as well as ensure registrar's approval if limits are exceeded. Now let's move on to the next one, that is restriction on loan. So under section 29, a society cannot grant loans to non-members unless allowed by rules or bylaws. So loans may only be made to other registered cooperative societies if permitted. And the auditor must ensure no loans have been provided to prohibited persons and loans granted followed by in-laws rules and proper authorization. Now let's move on to restrictions on deposit acceptance. So according to bylaws, a society may accept deposits from members, and acceptance from non-members requires special permissions. The auditor must check if deposits are from non-members and does that follow the legal provisions, and verify compliance with bylaws and state laws. The next is investment of fund. So the cooperative societies can invest funds only in permitted avenues as per section 32. They cannot invest in risky shares. The permitted investments are central or state cooperative bank, securities mentioned in section 20 of the Indian Trust Act 1882 like government bonds, RBI bonds, then shares, securities, bonds or debentures of any other registered cooperative society and limited liability companies if permitted, and any other bank or person carrying on any banking business including cooperative banks and other than central or state cooperative bank if approved by the registrar. And the auditor must verify whether investments comply with the act and bylaws and whether investments are authorized as safe. Now let's see appropriation of profits. So here appropriation means how profit is distributed. So let's see the mandatory transfer. According to the act, 25% of the net profits of a cooperative society should be transferred to the reserve fund before distribution of dividend or payment of bonus to the members. Why? To build society's financial strength. Cannot give all profits to the members. Second one is registrar's power. The registrar may direct a reduction in this percentage, but it cannot be reduced to less than 10% of the profits of the society. So 25% is standard. Registrar can reduce to 10% but never below 10%. So let's see the other appropriations. So apart from the mandatory transfer, a society may appropriate its profits by ways of transfer to other funds or distribution of dividends or bonuses subject to its bylaws and approvals by members in the general meeting. Now let's see the auditor's duty. Appropriation of profits must be duly approved by the auditor. Then the fifth one is contribution to charitable purpose. A registered society may, with the sanction of the registrar, contribute an amount not exceeding 10% of its net proceeds remaining after the compulsory transfer to the reserve fund for any charitable purpose. Now let's move on to the next topic, that is steps to be taken by an auditor. First one is general points. The auditor needs to perform the following: go through the bylaws of the society and ensure its actions comply with both the letter and spirit of those rules. Examine the register of members and including shareholdings. Test check the internal control system operated by the society and documents their strengths and weaknesses. The next one is audit of income, that is cash receipts should be carefully vouched or verified. So cash received against sales should be vouched with cash memos and invoices issued to the customers. The receipt of cash regarding interest and repayment of loans should be vouched with the loan agreements, and the cash received from members towards construction or maintenance of houses or demands made by the society should be vouched with the register of members, the original demands and money receipts. Now, the audit of expenditure. The auditor should vouch all expenditure with reference to authorization from the managing committee. That is, every payment needs MC approval. Then the bills received from individuals, especially for large capital expenditure. Then money receipts obtained from them. Then entries in the bank pass along with counterfoils of check and the payment of loans from the loan agreements entered into the borrower's members. Now let's move on to the last subchapter, that is audit of local self-government. So this means panchayat, municipality, corporation audit. They spend public tax money, so the audit is critical. So first let's see the meaning of local self-government. So this refers to government jurisdictions below the level of the state. After the 73rd and 74th Constitution amendments, local self-governance gained constitutional recognition. So 73rd Amendment means Panchayati Raj for rural and 74th Amendment brought municipalities for urban. So this operates at village, town, city and district levels, giving autonomy through elected bodies. So now let's see the different types of local bodies. There are two types, urban local bodies and rural local bodies. So the urban local bodies constitute municipal corporations, municipalities and nagar panchayats. So these cover large cities, towns and transactional areas. Then the second one is rural local bodies or Panchayati Raj institutions. So there are three levels: Gram Panchayat at village level, Panchayat Samiti at block level and Zilla Parishad at district level. So the common feature is that these bodies operate through democratic elections and citizen participation. Now let's see the functions of local body. So why do we audit them? Because they do important work. First one is implementation of development program like Swachh Bharat, MGNREGA. Then execution of state government delegated functions, management of local resources like ponds, markets, street lights. Then administration of grants received from states and center, that crores of rupees. Then execution of projects such as public works, roads, then the water supply, sanitation, etc. and maintaining records, accounts and reports properly. Now let's see the need for audit of local bodies. So local bodies handle public fund, therefore audits are essential too. Then ensure transparency, accountability and proper utilization of funds, as well as verify that expenditure meets legacy and regulatory requirements, as well as confirm that financial statements are correct and fair. Now let's see the main objectives of audit. First one is fairness and correctness of contents in the financial statement, accuracy of accounting records, ensure money is utilized properly for its intended purposes, and detection of frauds, errors and irregularities. Now let's see the scope of audit. So the auditor should consider appointments and responsibilities. Auditor must be appointed in line with the rules of the respective local body, that is for panchayat or for municipality. Then auditors must verify compliance with applicable laws, acts and regulations governing the body. Next one is understanding the laws and regulations. So obtain full understanding of relevant acts and rules, assess the governance framework and financial control mechanisms. Next is detailed audit procedures. So auditors should verify the records and meetings, as well as they examine the schemes and grants and inspect variations, verifying sufficiency of funds and evaluating economic efficiency. So with this we are concluding today's class. Until next, keep learning, keep growing. Thank you.